Hi everyone. Central banks and the economy. The relationship is a complicated one. After the 2008 financial crisis, we have 11 years of economic expansion. Recently, the U.S. 10-year Treasury interest rate dropped to 1.47% around September 3, 2019. The rate went up to 1.67 since then. The tumbling of the U.S. interest rate in early August caused a panic sell-off in the stock market. On September 4th, in an interview at CNBC, former Fed Chairman Alan Greenspan said, "It's only a matter of time. The negative interest rate will spread from Japan and Europe to the U.S." Greenspan's statement implied three things. One, U.S. is moving into a recession. Two, to combat the recession, the Fed will lower the short-term interest rate to negative. And three, the Fed will do QE as well, and the Fed's combined action will lower the long-term interest rate to negative territory. Most people believe when Mr. Greenspan was at the helm of the Fed, his easy monetary policy contributed to the forming of the bubble in real estate prices, which bursted and caused the U.S. financial crisis of 2008. Now the U.S. is facing another bubble in financial assets. Mr. Greenspan is foreseeing the Fed adopt another round of monetary easing. How will monetary easing solve the problem? Maybe all that Mr. Greenspan have is a hammer, and consequently, every problem looks like a nail to him. Didn't someone wrote a book and called Mr. Greenspan a maestro? I was always baffled by that anyway. Fortunately, there are many people who have different views on the economy. Among the bulls on the Wall Street, one stands out. He is Tony Dwyer. On September 15th, Tony was interviewed on CNBC, in which he says the economy just came through a mini-recession, economic indicators would be better in the future, and the stock investors should go offense. He believes the U.S. interest rate hit the bottom around September 3rd, and the interest rate will move up to 2.5% or 3% area. Then there's Jeffrey Gundlach, who was interviewed on CNBC on September 17th. Jeffrey believes recession is coming, and the Fed will lower the short-term interest rate to combat the slowdown. However, Jeffrey believes the long-term interest rate will move higher, at least for a few years. Another pundit on Wall Street, Julian Emanuel, who was interviewed on CNBC on September 18th, said the 40-year bull market in bond was over after September 3rd bottom. We will not see U.S. 10-year bond interest rate below 1.47% again. Mr. Greenspan said the interest rate will move down to below zero. Tony, Jeffrey, and Julian all said the interest rate will move up. Who is right? Let me try to analyze this and share my thoughts with you. First, recession is coming. Even Tony Dwyer agrees that the U.S. economy is due for a recession. The question is when. This is a $1 trillion question because that's the amount of money at stake for stock market participants who put their bets one way or another. I don't have a crystal ball, so I can't say when the U.S. will go into recession. But I will say this. The U.S. economy faces many challenges. The first challenge is the slowdown in the Chinese economy. The slowdown is clearly exacerbated by the trade war between the U.S. and China. The trade war may cause a liquidity crisis in China's current account and push the Chinese economy off a cliff. The second challenge is the unrest in Hong Kong, which may cause a liquidity crisis in Hong Kong's foreign reserve and pushes the Hong Kong economy off a cliff. The third challenge is the standoff between Iran and the US over Iran's nuclear program. This may boil over and push world oil price to sky high. The attack on Saudi's oil facilities on September 14th, which temporarily removed 5% of world oil supply, is a clear indication of the danger of this conflict. With the above three challenges in the background, the current U.S. stock market is traded at a valuation as if all three challenges will resolve themselves quietly, and there will be no other crisis to rock the boat. How long this high valuation will last is anybody's guess. We know the stock market usually nosedives 6 months before recession hits. However, Mr. Greenspan pointed out, this time around, a nosedive in stock market may cause a recession. It's a novel statement that we rarely hear. Mr. Greenspan is a highly respected economist, so I usually don't question his statement. But stock market collapse can cause recession? Really? President Donald Trump must share the same belief as Mr. Greenspan, because the president had used his tweets to rescue the stock market many times, and it worked like a clock. The more interesting question is, if the U.S. goes into a recession, which way will the interest rate go? Will interest rate go into negative territory? On how to tackle a recession, there are two major camps, or two major schools of thoughts. The first school is the laissez-faire capitalists, who insist on allowing banks, financial institutions to fail and allow the creative destruction to work its magic in economy. They say a healthy, robust economy will emerge out of the ruins and ashes of an economic collapse. The second school is the Keynesian school, who believe the government should create money out of thin air and rescue the banks, the big institutions, in the event of economic collapse. That was the approach adopted by Hank Paulson, Ben Bernanke, and Tim Geithner during the 2008 financial crisis. Yes, those were the three. The guy at the wheel is Hank Paulson, I believe. At the 10th anniversary gathering of the 2008 financial crisis, Tim said the three-person team put the U.S. economy on the path to recovery. And this is what he said, the best part is, it didn't cost the federal government a dime. I could not believe my ears when I heard this. Maybe the federal government recovered all the money they spent on top. But what about the ballooning federal deficits year after year since then? What about the huge balance sheet at the Federal Reserve accumulated since then? What about the increase in the national debt? Everyone wants to feel good about himself. Perhaps Tim should be a little more vigilant about the words when he speaks publicly. On dealing with the next recession, Mr. Greenspan's prescription is still QE, which means printing money to bring down the long-term interest rate. It had worked during the past 11 years. However, will QE still work the next time? That is the question. Fortunately or unfortunately, Japan's experiment with QE in the last 15 years has provided answers to many aspects of the question. For example, we now know continued QE over many years provides diminishing stimulus to the economy, and QE has many serious side effects which are difficult to get rid of. What is QE? QE is the buying of private assets to recapitalize businesses and prop up asset prices using fiat money. Whenever a government uses fiat money to prop up institutions or individuals, it rewards bad behavior. and creates a moral hazard. When an economic downturn comes, stock market will drop at least 30%. Some weak businesses will go under, unemployment will rise, some corporate bonds will default, all asset prices will drop, and people would feel much poorer because a lot of wealth had disappeared. In such a case, the government and central bank's main tasks are: first, inject liquidity and make sure the system still functions. For example, propping up all institutions that perform essential functions, such as the major banks. Second, help individuals who were hit by the recession. For example, offering better unemployment benefits and extending welfare benefits both in time and in scope. Third, allow the asset prices to fall below bubble territory. For example, allowing certain individual and businesses to fail, like the Lehman Brothers. Fourth, provide a bottom to asset prices so that it does not move down too much. Fed did this through its QE, which spanned across over 6 years. All above four are legitimate tasks for the government and the central bank. The US government and the Fed did all those four tasks to get us out of the 2008 recession. Many people say the Fed will have a hard time accomplishing task 4 in the next recession because the Fed already has a huge balance sheet. If the Fed cannot successfully put a bottom to asset prices in the next recession, then there will be a severe deflation and long-term interest rate will be high. In that scenario, we could see riots on American streets and white men protest in peaceful ways, or maybe not that peaceful. We certainly don't want that to happen. Mr. Greenspan foresees a different scenario. Greenspan said, because American population is aging, lots of wealth will be in the hands of retired people, and retired people rather put their money in bonds and not something risky like a Uber or WeWork. That is why we will see negative interest rate in the US, according to Greenspan. I think Mr. Greenspan is right. We already give trillions of dollars to the banks, to Fannie Mae and Freddie Mac. The essential institutions went through stress tests forced by the Fed not too long ago. They are sound. US corporations have tons and tons of cash. They are fine. The shadow banking system, well, it's in the shadow. The only trouble is the US federal government, which is bleeding $1 trillion every year. This can easily be fixed, right? We could all put our feet up and relax, because there's another thing to worry. Thank you for watching.